But yeah, I mean, maybe you can speak a little bit to, the definition of futures spreads and what you look to get out of them, as opposed to buying or selling stocks or buying or selling the 10-year yield. Why put them together? And what are you looking for when you do put them together?
Beautiful. So a couple of things that you just mentioned. So first and foremost, I think about spreads in two different ways. One is this idea that you have listed on the slide here of creating positions in correlated markets. And so that's when you're trading a relationship between two products, like you'll see in an upcoming slide that we have here. The other way that I think about spread trades is that other idea where maybe I have a really strong directional assumption in one product, and I want to maybe offset some of my risk by using a correlated product. So it's either one of those two things. I'm trading the relationship, or I'm using it to potentially soften if I'm not correct when I first initiate a trade. With that, of course, depending on how they're correlated, whether they're positively correlated or negatively correlated, that will impact how we're actually setting up these future spreads, whether we're long one and short one, or we're long and short, depending on that correlation. And the last piece of that, what constitutes as a correlation in our eyes. I think that definition can probably vary because, as we know, correlations ebb and flow over time. But typically, if I'm looking to put on a spread trade, I want something with a relatively strong high positive correlation or a relatively strong high negative correlation.
100%. And for the sake of today's conversation, made it very simple for you all. These two markets here, the 10-year yield, which is the benchmark for interest rates, and then small stocks, which is a solid benchmark for stocks, but kind of similar to your S&P 500 there. These two markets move together. When times are good, stocks and interest rates are climbing higher. When times are bad, they're falling lower. And so you're seeing a high positive correlation and two markets that you take offsetting positions on. And I love that you brought up this piece of like trading the relationship between the two things, or kind of softening my idea on stocks or interest rates. Because I think actually the way that we'll conclude today's discussion of spreads is with a trade idea that kind of does both. And it really didn't occur to me until you just said those words there, because I think this is perfect for doing both of those things. And I'll get to how to do that here in a second. But the basic idea here is extremely, extremely recognizable to those people out there who trade volatility, which is to say, this is a mean reversion game. And what you have here now is the spread price, which is the stock market minus the yield market, and we're doing three yields to a stock market, just given the difference in sizing and volatility. But this is a mean reversion game, right, Katie? Like, the idea is these two things are highly correlated. They move up and down together, but in tumultuous times like we're seeing right now, one of them can move in one direction and the other in another direction. They diverge, and then we play them on converging. And you're seeing that with the stock market. Everything fell the last 2 weeks. Stocks recovered really well. Yields are kind of hanging lower. And so you might look at selling stocks, buying yields with the reversion of this spread lower. I mean, that makes sense from like an options perspective, right? Volatility high, I sell it. Volatility comes back, I buy it back, right?
Exactly. Yeah. And I love this visual because when I was first learning with Pete about spreads, it took me a while to understand and wrap my head around, like, okay, if I'm seeing this chart where there's like a strong, I'm just going to call it like a positive stream or a positive extreme above the mean, like this is telling me just what you just said. Stocks are probably outperforming relative to how this 10-year yield is performing. So therefore, if I'm subtracting these two prices from one another, that gap is bigger than it has been historically. Mm-hmm. So I know that like, maybe I'm sounding like I'm trying to explain it like I'm five, but that's what really helped me get over the hump in terms of like, okay, now that I know that this gap is wider and I want it to come closer together, what does that mean for how I set up this position?
No, I think you nailed it there because that's exactly how I would think of it. And I mean, look at this chart and watch me go back and forth. The red line is yields, white line is stocks. You can see red line outperforming the white, yields outperforming stocks in the early part. And now you see that red line, the yields actually underperforming stocks recently. And that's going to correlate to this exact chart where the spread is moving lower at the early part of the year as yields are outperforming stocks. And now the spread has moved higher as stocks outperform yields. And this is a relationship trade. It's a mean reverting trade that, of course, stocks can continue to take off and yields can stay here or yields can go down to zero. But, we look for high probability trades. We look at stuff like this and say, hey, that's an outlier. I'm going to bet against that outlier getting even more outlierish and thus, trade both sides. Like it's really, I always love to go back and forth, and maybe I'm dwelling on this too much, but looking at the two charts on their own and seeing, this gap here and then this gap here in the opposite direction quite literally is the movement lower here and the movement higher that we're seeing here in the spread market. I mean, it's really great and essential for you all to see that, to understand that, because then at the end of the day, it's just a matter of like, okay, I would have wanted to, in March, I would have wanted to buy the spread. And now I would have wanted to sell the spread. Selling the spread just means selling this thing and then buying this thing against it and looking for, like Katie says, those things to kind of come back in line. It's all kind of synergetic, part of the same organism in spread trading.
Exactly. And the other thing too, that I think that is worth mentioning here is that, okay, yes, you're buying one of these items and selling the other. Of course, in an ideal world, like those would move in the direction you want to, but you can still be profitable with just having one of those pieces be right, as long as it's more severe, I guess, if you want to say that, then the other piece that might still be working against you. So say that I am selling SM75 and buying S10Y, but we still continue to kind of climb higher in stocks. But if I have a really significant correction in this S10Y trade, that could still make this trade profitable. So just because you are long one and short the other, of course, you would want those to actually move in a nice little lockstep to be profitable. Sure. Where you would have incur no type of unrealized loss over the duration of the trade. But for beginners out there, you can still be right, even if only one piece is actually working in your favor. It just depends on how swiftly or significantly that piece is moving in your direction.
Yeah. And the opposite example is we see a stock market crash or just a fall of 2, 3, 5%. In the next couple of days or weeks or what have you, and stocks just move lower by a greater amount than yields move lower here, and you get paid that way. You're going to most likely look at your positions tab and be red in one and green in the other, and you're just looking for the mean reversion just comes in the way of that green number being higher than that red number. And what's really nice about this is, it's a unique strategy. It's opportunities that, are combining markets. And like Katie says, it kind of softens the movement. It's like a hedged strategy that's maybe less volatile than just buying or selling the stock market. But also I love this because it takes your watch list of, say you only look at 10 futures, or you only look at even 5 or the 4 that I have up here. And it takes you from having 4 potential trade. I'm buying or selling one or each of these or what have you. I can only do so many things. And now I've got a bunch of permutations, especially if I look at not only stocks and bonds, but stocks and commodities and foreign exchange. And I start mix and matching these things that have high correlations. It just opens me up to getting paid in so many different ways that you just can't see any. It's like the first time you go from trading Apple to being like, oh, I can sell a put, or I can sell a call, or I can sell both, or I can sell a put and buy a call. I can get paid these different ways. It really puts your watch list on, steroids, so to speak.
Yeah, absolutely. And I think the thing too that, I'm probably a broken record at this point, but working smarter, not harder. when I go and I open up like the small exchange newsletter, I see a correlation table that tells me right away, okay, with SM75 and S10Y, I think the newsletter you guys sent out on Monday said it was like a 0.6 positive correlation, which makes sense that we would buy one and sell the other. But maybe if I looked at that table for some of these other permutations that you have, but they were floating closer to somewhere around like 0.2 or 0.3, I would be like, all right, I'm going to throw that one out the window for now and look to some of these other pairs, whether they're positive or negatively strongly correlated. And maybe that's a better use of my capital at this point in time.
Absolutely. And just because you called it out, not because I'm a shill, but I have to now. Katie is speaking about the small newsletters, goes out to all of the members of the small exchange, and you can join the small exchange here today, community.thesmallexchange.com. You get the newsletter with updated values every week, which Katie so thankful that Katie does this, always plugging how much she likes our newsletter. And you also get 50% off all your trading fees for life and a bunch of free giveaways. And so you have one of our t-shirts for the small exchange members, right?
I do. Yeah. I'm really rallying for some like small exchange and tasty crew necks going into the new year. I mean, I think it's probably a little too late for Santa to deliver one to me on Christmas, but maybe, we've still got like 4 months of winter in Chicago. So maybe there's some time for some new crew neck gear. That would be a nice addition to my wardrobe in the future.
We will absolutely work on it. As you can see, I'm way ahead of you with my crew neck Bulls Snoopy sweater here. We'll get that for you. But yeah, community.thesmallexchange.com. You get all of the data and reduced fees and everything else. Enough plugging. Let's finish up the segment here today, because I do actually like this particular example. And I like I say, the way that Katie kind of shaded it, which is maybe we don't do this on a full 1 to 3 and we get a little short delta in the equity column by under hedging in interest rates. But either way, I just want to bring it all home with this idea of mean reversion. And those of you out there who are privy to options trading and everything else kind of understand this. But Katie, maybe you can give some conclusive final notes on just what this means to you. It really is like, not everything is mean reverting, especially the equity market. We know that the equity market tends to drift higher, right, but there are a lot of markets like interest rates and also spread markets that kind of have a historical relationship, or even like volatility, the VIX. They have this historical kind of range or relationship, and you can feel pretty comfortable kind of sticking your neck out and leaning against historical data to say, when this thing gets high, I think that there's edge in selling it. When it gets low, there's edge in buying it. This mean reversion theory, it feeds into everything. But at the end of the day, it's kind of as simple as that, right, Katie?
Exactly. Yeah, I think you really hit on it. I mean, when you showed this to me or sent it to me last night to kind of look over, I was truthfully, like, this has not even been on my radar. So I just love that we had this conversation, because like you said, knowing this kind of information, and if you're strapped for trade ideas and you're feeling bored with just outright directionality, this does kind of put your repertoire or skill set on steroids a little bit. So yeah, you absolutely nailed it. This, of course, is an extreme that we're kind of seeing in here. We know that there is a historical correlation between equities and the interest rate or yield space. And this is one way that we can kind of start to participate. The one question that I had for you here, because I'm sure the question that like somebody new would say is, okay, why is SM75 just one contract and the 10-year is 3 contracts? Are you basing that off of the notional exposure that you're getting on each contract, or are you coupling in volatility with that? How are we determining this ratio?
First of all, love the question. And I love what Katie just did, because I'm going to lift the curtain a little bit. Katie just essentially, you are Lonzo Ball to Frank's to Frank's who would be like the guy that throws down the dunks on the Bulls. I mean, Lonzo can dunk in his own right, but like I'm Zach LaVine. Like, you just threw me the ball and I'm about to score a layup, everybody, because Katie, I know, has done this a million times, which is you adjust for the notional size of the market and the volatility of the market. And Katie and I have both crunched those numbers for one Pete Momat. to the tune of probably hundreds of times. And
sure.
what's really nice is thanks to efficient margining in the futures space, you actually can take volatility adjusted notional sizing. That's what we used to call it, friends. And you can kind of throw it out the window and just look at the margin on these products and just say like, okay, if I want to be short the SM75, that's going to cost me about $1,000. And then I want to buy interest rates against it. That's going to cost me about $400 to buy the 10-year market. Now, it's imperfect because 400 doesn't cram into 1,000, but right there, that lets you know you need 2 or 3 of these 10 years to offset the position in the other one. And Katie and I used to have to find volatilities, multiply the volatility by the price
notional
times the multiplier for the futures. A lot simpler here, just doing it in Tastyworks with this idea. But where I want to conclude is, first of all, bringing up the pairs trader, but then also kind of dismantling this 3-to-1 trade. Because like Katie said at the start, you can kind of view this as a softening of your idea. And it's kind of how I would view this here. Stock market showing a lot of volatility, big sell-off last week, still up considerably on the year. And this is one where it's like the market has shown me it can fall, and now it's back to those heights. And I'm looking to get some short deltas going in equities. And so what I'm going to do is, instead of doing 2 or 3 of these 10 years, I'm going to do just the one under hedge. And essentially what I'm doing here with the 1-to-1 trade, Katie, is I'm short equities and I'm hedging part of it, like a third or half of it, with a long tenure position. What say you?
That's beautiful. I mean, and, especially this is powerful for if you do have a strong idea in one of these products over the other, but B, it takes your buying power from something like $2,200, which might still be a tiny bit hefty for people in smaller sized accounts, down to about $1,500. So you're chopping your buying power pretty significantly. Again, you just kind of need to know, okay, which is my stronger idea here? Which is like the higher beta piece that I want to perform? And then the other piece of that is just kind of an add-on, I guess. I don't want to downplay it, but that's essentially what it's become.
Absolutely. And this also works for like if you have short deltas in the equity market from other positions. Maybe you sold a QQQ call spread or, whatever. Buying 1 or 2 of these 10 years, still making sure you're under hedged, because you still want, your idea is equities to move lower. Buying 1 or 2 of those without even the idea being like, oh, I'm spreading these off in the pairs trader here. That's just like a nice thing for your portfolio to have. That's risk management. That is, hedging in a case of like, I'm short equities. I don't know if they're going to fall today, tomorrow, or sometime in the future. Yields that are highly correlated to those equities are still kind of hanging around those lows. I'm going to pick up a couple of these. And if they move higher as equities kind of swirl around their highs, then I can take that hedge off for some profits in the short term. So all this stuff can be kind of dismantled however you want to do it, whatever works for your portfolio. But yeah, the base case, I would look at a spread of, 1, 2, or 3 of these 10 years to the SM75. And given the recent activity in this spread, I would look for probably like $200 or so of profit. And this is one that I'd feel comfortable holding for, as long as a week or a couple of weeks. And there you have it, a little spread trading action, stocks and bonds in the market. What do you think, Katie? I think we did. I
love it. Yeah. The only other thing I wanted to call out too is we're in December now. So of course, when you're talking about holding these pairs trades, be mindful of what will ultimately become the active month. So as you said, I think we're thinking of doing both of those in the Z contract because you have a shorter term outlook. And of course, some of those contracts have not rolled over to January yet because they're not the active month, but always keep an eye on that. The brokerage firm that you are with probably will send you a heads up that, hey, these contracts are going to expire. If you want to maintain your position, you might have to roll it out. That's my only final piece to keep an eye on with this trade, but I love it.
Absolutely. That's absolutely right. Yeah. Well, hopefully looking for movement in that spread for the next couple of days or so. But yeah, absolutely. If we get into next week, Tastyworks, great about notifying you that you have futures that need to be rolled to extend duration. So we'll deal with that when we get to it next week on roll week for the small exchange. Katie, thank you so much for joining me here. Always a good time hanging out with you on the small stakes segment. What are you going to do the rest of the day now?
I guess I'm going to go kiss babies and, I don't know.
Weird thing. I wouldn't tell people that necessarily, but whatever you do in your free time is up to you. There might be some illegality to kissing other people's babies non-consensually, but I mean, I'm not going to narc on you. That's up to you. That's your business. Katie, thanks so much for joining us here on Small Stakes. Everybody, thanks for watching. Splash into Futures coming up next. I'll be joined by Peter Molmat. We'll be perusing the Tastyworks platform for a bunch of futures trades on yet another weird day in the market. Thanks for watching, everybody. Peace.
Peace.